Hello there, welcome to the last week ahead show of 2016. The year that saw the US presidential victory of a billionaire reality TV star. Britain voting to leave the European Union, the sobering reality of China's debt bubble beginning to surface, the rise of the far right in Europe, and Leicester City defying the odds of 5,000 to 1 to win the Premier League, demonstrating that anything is possible. So it's time to open up our brand new 2017 diaries and see what's on the agenda for Monday the 2nd of January, which will be a public holiday for the UK, US and much of Europe as well. But still plenty to trade, including numbers from Italy, Germany and the Eurozone. It's those manufacturing PMIs. For Tuesday the 3rd of January, there's lots of numbers to contend with. China is a big theme for the first week of the year. France CPI, Germany unemployment, UK manufacturing, Germany CPI too, as well as US manufacturing. So lots of PMI manufacturing, so that's also one of the themes that we will discuss later on. UK numbers as well, it's the BRC shop price index, PMI again, Japan, Germany, UK, Eurozone, US ADP employment, the FOMC meetings and crude numbers. In the latter part of the week, on the 5th of January, we're looking out for that ECB monetary policy report. Again, US data really dictates the week. Initial jobless claims, PMI as well. Friday the 6th of January, we've got the current account coming from France, Switzerland's foreign currency reserves, and again, US non-farm payrolls. That's the big one. Hello again. So let's talk about some of those numbers in further detail. Chris Beecham is here to put it all in order for us. Chris, as I just mentioned, the US, loads.
Yeah, it's going to be a busy week for the US, which is quite nice really when you consider how much attention has been lavished on the American economy in the last few months, thanks to the election, and of course, thanks to that Fed interest rate increase in December. But it continues into the new year and culminates on Friday with that non-farm payrolls reading. And the big questions really are, does the US economy warrant the strength for the Fed to raise rates 3 times, which is their official plan for next year? And how will the economy develop as we see the new administration coming into power? So it's a bit of a prelude, if you like, this week in terms of US economic data, but certainly well worth watching out for in terms of non-farms on Friday, but also there's PMI numbers. You get services and manufacturing on Tuesday and Thursday, so also really ones I think definitely worth keeping an eye on. In terms of the market impact, of course, you can go, I think you do worse than looking at the US dollar basket on the IG platform, which is that dollar index, an index of currencies versus the US dollar. You can see the strength we've had in this index since October. It's a classic uptrend here. You can see steady progression of higher highs, a little bit of a pullback, then a new rally to a new high, then a pullback. And again, of course, we've been up at 103 on this index. Now, since the middle of December, we've had a bit of weakness. So it will take quite a strong reading, I think, on US data, especially on those Friday's non-farm numbers to push this one higher. I think there's a bit of uncertainty really over whether the dollar should be this strong. So you could see a bit of weakness, but as we can see on the chart here, you've had a good uptrend since October, and we're just sitting on that uptrend line right at the moment. So if it does break below there, if we go say below 102 on the index, then that might suggest we've got weakness further ahead, but definitely a key week for US data.
Okay, it's just remarkable, isn't it? We're just back into 2017 and we're already kick-starting with those non-farm payrolls. There really is no rest for the wicked, and it'll be full throttle once again. UK though, we've got market manufacturing PMI, construction PMI and services PMI all due Tuesday, Wednesday, Thursday.
Yeah, it's a key week for UK data as well. Those 3 big PMI readings. Remember, services PMI is the biggest and most important because it's around 2/3 of the UK economy. But all 3 taken together give us a very good picture of how the UK economy is faring or has fared during the course of December. Now, if you remember, a lot of people predicted that the Brexit vote would lead to quite a big drop in activity in the UK economy. We'd have a lot of weakness coming through. That's not been the case in these PMI readings. They still remain very, very strong, well into the mid-50s in terms of their performance, which separates a reading below 50 suggests the sector contracted in terms of activity. Above 50 continues to point to good times ahead. So we're definitely seeing even a little bit of weakness here would still suggest that actually the economy is moving in the right direction. So the place to watch for the impact there would of course be something like the pound against the US dollar. And if we look here, of course, we've had plenty of volatility in this currency pair over the last few months. Now, we had that big drop in October. We went down as far as 120 or so against the US dollar, and then we rallied up towards 127 at the beginning of December. And then over the last few weeks, that dollar strength we were talking about a minute ago has just seen the pound drop back towards 122. But it's been rallying the last couple of days. So I think if we do get some decent readings on these PMI numbers next week, you might see a bit of strength in sterling, perhaps back above 123 against the dollar, maybe pushing on back towards 125. But looking over the rest of the year, it's clearly Brexit will dominate. So we can expect a lot more information on what happens with Article 50, what the new relationship will look like. And that, again, will feed back into UK economic data as well.
China, always a big theme. It's been a massive theme for 2016. So we've got manufacturing PMI due as well. We've got the Cajun numbers as well. Obviously, China, the yuan is now loitering around the 1994 low, something like that. It's been a big theme, hasn't it?
And it's going to be a huge theme for next year as well. Remember, of course, China has this limit on the amount of currency you can take out of the country every year, but that limit resets at the beginning on January the 1st, essentially. So you could see further outflows of foreign currency from China. It's a big thing to watch for. And you've got the debate over what happens with the US and China. Is there going to be some sort of trade war? Will the new administration look to retaliate against what they perceive as China's manipulation of its currency? So those PMI figures, though, will be still very important, because how China's economy fares is very important, not just for China, not just for Asia, but the entire global economy. So if you get a bit of weakness there, you might see quite a lot of jitters go through global markets as a whole. But one area to watch for might be something like copper. Even if you're not trading it, it's always good to keep an idea of what copper's doing, really. And we had a fantastic rally here in October, November and December, up towards about $2.70 a pound for copper. But we've come off since then in December, quite a bit of a retreat. The big question now is, do we move higher from here? Have we seen sort of the end of that weakness? And again, it always goes back to the US dollar. If that weakens into the beginning of 2017, that gives metals like copper a bit of a breathing space. So we've talked recently about how gold might do better thanks to a weaker dollar. The same thing applies here with China. So watch out for the economic data. Keep an eye on copper, things like mining stocks as well, and key risk currencies like the Aussie against the US dollar.
Okay, great. In the corporate world, though, it's a lot quieter in the first week of 2017. Wednesday's really where it begins with Next, obviously a huge retailer here in the UK. Tremendous sales this week. Their shops have pretty much been emptied. Thursday is busier, Persimmon there, Monsanto there, and Walgreen Boots Alliance. On the Friday, it's EasyJet as well. It's really been plagued this year by terrorist attacks and threats and concerns, as well as strikes too, and of course the sterling fluctuations as well. Chris is still here to talk about some of those. Should we kick off with Next? Obviously, it's a retailer darling here, if you like, isn't it?
It was, certainly. Back at the beginning of this year, we were trading about £70 a share, and now we're just below that £50 a share mark. But Next is interesting because of obviously being something of a retail bellwether, if you like. And we should get some information in this trading update next week about how they've done over Christmas, and that will set the tone, I think, for the retailers for the rest of the month. We should get more from the sector heading into January over how they've done over that key Christmas period. Next, if you look at the chart, though, we've had a beating in the share price, really. It's been a very difficult year, and for a company that previously could do no wrong, it actually has really seen a lot of the shine come off it. We've had constant warnings about the failure to manage their stock properly, the changing seasons, obviously the usual complaints about the weather being a problem, and that's why the share price has suffered so much. If you're looking at it from a charting perspective, clearly you've got a downtrend here. We've been pushing steadily lower all the way through the year, down to this low about £45 a share. But twice this year we've been down at that level in June, and then you can see in October as well, £44 a share. And since then, it's sort of plateaued out, if you like. So maybe we haven't seen the end of the downtrend, but maybe there's that sort of bottom in place now for the time being. And I think the trading update we get next week could well set the tone for the rest of next year. And hopefully, well, certainly the board will be hoping that the year ahead is much more congenial for Next than it has been over the past 12 months.
I think Next at the moment has a problem of where it places itself. Is it budget? Is it high end? Is it a Marks and Spencer's? Is it a Primark? It's in the middle, and that's probably the most competitive sector when you're talking about clothing. Let's move on and talk about Persimmon. It's a trading statement. It's due on Thursday for this month.
House builders, very interesting. They've had obviously a very difficult year. You saw the share price knocked back, and this week we've had a sudden trading update from its peer in the sector, Bovis Homes. Not quite a profit warning, but saying that they don't think they'll complete as many houses or sell as many houses as they thought they would. So that put a bit of a downer on the sector as we head into the end of the year. Persimmon will be then very interesting to sort of compare and contrast, if you like, to see, are they having similar problems? What do they see in terms of demand? What about, of course, inflation in terms of costs? Is it getting more expensive to build those homes? Now, the sector as a whole has had a difficult year, if you like. We were riding high at the beginning of last year in terms of house builders. They've done fantastically well the last couple of years. Demand was strong, and then Brexit came along, and the share prices got walloped, essentially. They recovered off those lows, but as you can see from the chart, Persimmon is sort of a good representative of the broader sector. We haven't really gone anywhere since about September. I think people look at it and think, well, the company's cheap, the share price is well down on where it was, but concerns about really where the house prices go next. So again, like with next trading update, Persimmon's could really set the tone for the first few months of the year in terms of, do shareholders still think the sector looks good value, or is it one to avoid for the year ahead? So we want to see some good news, I think, coming through from Persimmon.
A company that needs some good news is EasyJet. Now, it is just the traffic figures, but obviously it gives us a great idea as to how the company is doing. People potentially booking their New Year holidays. I mentioned some of the barriers that the company has had to face, lots of turbulence.
Yeah, I think that's a fair thing to say, really, with EasyJet. And I think it's almost not quite lost the war with Ryanair, but it's certainly come a distant second to Ryanair, its Irish rival, which has really done well to repair its image, to sort of win over airline travellers. And they are very picky, of course, where they go. So EasyJet has suffered in comparison. The share price has taken a beating over the last 12 months. If you look a year ago, we were trading about £17 a share, and it held up reasonably well. But since then, it's steadily moved lower. It's been really hit hard by Brexit, and again in October we were down below £9 a share. Now we've recovered there, but I think EasyJet again suffers by comparison with Ryanair, which seems to do no wrong at the moment. So they need a fairly good trading update, I think, in terms of their traffic statistics, in terms of that load factor, how many people you've carried and what sort of percentage of each plane was full. So the market will be watching out for that, really, for signs that the budget airline sector might be in for a tough year. And of course those terrorist attacks in various places aren't helping matters either. So it's definitely one, I think, to watch for consumer sentiment into 2017. And
when it comes to competition, Ryanair is fierce and fearless. They will do anything to stay on top.
Exactly.
Anything else to conclude the week and how we can prepare ourselves for the first week of 2017?
Well, I think we enter into the end of the year and the beginning of the new year with a sort of interesting time for markets, because you've had a turbulent year, I think it's safe to say. We've seen a lot of changes in the political landscape, in the economic landscape. And the question is now, where do we go from here? And that will become clear only over time. Now, if you look at something like the S&P 500, it's had a fantastic year on one sense. We were trading well down at 1850 in January and February, and since then we've stormed higher. The overall change on the year is not too great, because we were trading at the beginning of 2016 about 2050. So we've gained about 200 points since then. So not a bad year, really. Probably quite just above the average, really. But stocks have had a great run since November. And the question is now, can they sustain that? Or do you think we'll get a bit of nervousness heading into the period before the inauguration? Because people expect Trump to deliver. And if he doesn't, or if he doesn't deliver as much as people think, then we might be in for another market panic. But I think the lesson of 2016, the one thing we should take away is that every time this market has had a bit of a panic, a bit of a sell-off, we had that in January and February, we had it with Brexit, we had it with the election. Every time they panic, and then people have stepped back in again. So do keep your wits about you, manage your risks appropriately. But remember, this is fundamentally still a bull market, i.e. prices do tend to go up. So in a sense, as an investor, you want the odd market panic because it gives you the chance to buy shares at cheaper prices. So do watch out for them. They will be volatile times along the way, but overall the bull market remains intact.
Right. Bulls, here we come then. Thank you very much. That's Chris Beecham right there. So that's it from us here in London. I'd like to wish you all a prosperous, healthy and a very happy new year. I hope to see you all again in 2017, and I'll be back very early in the morning on Tuesday at 7:30 a.m.